Welcome back, viewers. Today, we have a couple of topics to discuss. One of them is the dividend strategy, how I'm progressing. And on top of it, we're going to talk about something about yield trap, what it means, especially in the dividend strategy. I learned it as I was just going through investing in dividend strategy. NAV erosion. NAV, it's actually a net asset value erosion, how the NAV is depreciate for some of these stocks where they're underperforming, but they're giving you a high yield. Some of these companies, some of these stocks, how are they compensating the cost, expenses, as well as the growth, capital growth? How are they negatively impacting the capital growth? So those are some of the things comes under NAV erosion. In general, topics covering market condition, how things are moving on the S&P, Nasdaq, and all these big time ETFs, and a couple of monthly stocks to view. Of late, I've been looking at the dividend strategy deeper. I could confidently say that I'm completely moved out of being a swing trader now. I'm totally into the dividend strategy model. I was a little bit hesitant to change my strategy to dividend model. I was thinking that maybe the dividend model won't give you enough return end of the year. But going through this dividend strategy and making sure right set of stocks are picked up and you invest in these right set of stocks with a proper dividend yield as well as a good growing companies, their EPS growing on a regular basis could help you to attain the same output or same return when you do with the swing trading. Okay, when you compare both the strategies, they have their own pros and cons. And I think when I look at the dividend strategy, a lot of pros which I felt comfortable to take that route and achieve what I want. So confidently, I can say that I moved out from swing trading. Sometimes I get itched to go and try out some swing trading, looking at some of these exciting stocks in the market right now. Some of the semiconductor stocks going on, some of the pharma stocks are making some money. I get pulled into those kind of things, but I tend to stay away from it. uh, and I'm sticking to the dividend strategy 100%. Um, and since July, I've been trying it. It's a 6 months. Out of the 6 months or 6 to 7 months of try, I could confidently say that I've achieved a 14 percentage, 14.11 to be more precise, 14.11 percentage return in my kind of 100K investment, which is out of 100K, you're getting somewhere around 14K is the return which I'm seeing, which seems decent return compared to what the other investment, outside investment gives you. Even if you go for a financial advisor or managers, fund managers, and give your money to them, they're probably going to commit to somewhere around between 13 to 15%. So I'm with my own research and approaches, what I got was around 14.11% for 6 months. So which means that in another 6 months I could get another 14%, but realistically I would say I can taper down to 10%. So around 25% return is what I'm looking at, I'm targeting for. But I will keep you posted when I hit my end of the year video. So to summarize this one, dividend strategy is a working strategy, very peaceful strategy. I would say you don't need to watch the market on a daily basis, staying on top of it, and making sure that you don't miss the opportunities. And sometimes you feel bad about it, of not being fully committed to the swing trading and market conditions and growth and all those things. Dividend strategy is a different style strategy. I would say it's a more peaceful, more calm approach of looking into companies a little bit deeper, trying to figure out what their EPS growth is as well as their dividend yield growth is, and try to figure out what companies matches your return, what you want. Right. This is kind of the dividend strategy. So I've been doing my homework, and I'm sharing whatever I did homework and investments and the returns which I got. And here is a summary of what I could achieve within this 6 months time period. So I removed the Jan and Feb month out from the list because I want to just realistically look at for 6 months what was my achievement. Looking at these numbers from July to December, uh, you could see that here the breakdown which I have it in the screen. You could see it's a monthly breakdown. I have the dividend, and then right next to it is the profit and loss. P&L is the profit and loss. Now you could see earlier the dividend was pretty low because I was trying to find the right set of stocks to invest in, and I was investing it on a regular basis. So initial returns were slightly low as I figured out through my monthly research activities. As was I was just trying to figure out some of these stocks and trying to play around with them, see what their yields are. So again, some of these things are trial and error basis. So you need to figure out how long to keep the stock or how long to stay invested in that company to get a dividend, right? Some of these tryouts were early, were done early. So that's why July, August time frames, you see lower returns on the dividend side. But at the same time, you can see the profit and loss too. I have some negative numbers in the sense I sold stocks where I had to take a hit. For example, July month, when you are switching from a swing trading to a dividend strategy trader or a long term trader, you tend to carry it away with the stock movement too. Sometimes some of these stocks progress slow because they are paying you dividend. Their growth is the capital growth will be slow, so you tend to get nervous and pull your money out. That's what happened in July, August timeframe. And then as I was learning, I was trying to figure out, okay, what, this may, pulling the money early may not be the right strategy to go. So that's why you see there's in July month I have a 5,600 hit loss. And then August month I did the same mistake again. I tried to keep the money on a good dividend paying stock, but their progress was a bit lower. So I thought maybe I did a mistake in investing in that company, so I pulled that money off, and then I had to incur some expense there. So expense or generally loss there. So July, August is when I had a big hit. And then gradually, as I learned what I was doing, like the dividend strategy, I could improve my approach and stay longer. The main part, the key part of a dividend strategy is to invest in the stock and stay longer. That way these companies pay you dividend on a regular basis. So this is kind of a summary. So looking at from July to December is what I could achieve: 14k, 14.11, 14, basically 14.11 percentage of return. And I did remove Jan and February month out from that summary. I'm going to just monitor from Jan to June how I'm performing. Then in the year end video, I will let you know how much I earned. So overall, I I was able to hit 24k something with a loss of 7,300 something, a total return of 17k. So if you look at till February, the return is around 17.31 percentage out of your 100k invested. So that's kind of the aggregate I wanted to share with you as I was doing this research. This should help you to understand, dividend strategy is not a bad strategy. It is a proven strategy. It is a working strategy. If you keep the money longer on some of these best dividend paying stocks, you earn very good money, and the compounding investment back into the stock would even get you better returns. When you do the dividend strategy approach, one common mistake investors do is that they get trapped into this yield world. We call that as a yield trap, and I went through it. I personally went through it, and I was carried away with finding stocks where they're paying you high yield, dividend yield, and without looking into deeper into their company, I invested money in those companies. So the trap, that particular trap, we call that as a yield trap. And especially this happens when you're new to this dividend strategy and you want to earn higher income, and you don't look at what type of companies you're investing in, and you just want to purely go based on the yield, what they're giving or the company is paying you to the investors. And that model is called as the yield trap model. But before getting into that yield trap, right, the basic thing to look at it is, what is a dividend yield? Dividend yield is nothing but annual dividend per share divided by the price per share. Basically, if they are paying you a $5 dividend, annual dividend of a $50 stock, which means that you have a yield percentage of 10, right? Or basically you're getting a 10% yield. That's why we call it as dividend yield. So the higher the dividend yield is a most attractive unit for all the dividend strategy investors. So they look at the company saying, okay, you know what, they're paying you higher dividend yield. That's naturally a place to go put your money in, right? Because they're paying you higher returns. But when you look at their company, their business, the financial state of it, good chance that they're not doing the right things in their business, and they're attracting more investment from the investors. That way they can keep doing their things of mishandling their finances, or not attracting or not doing the businesses in right way. Those are some of the negative part comes with a higher yield dividends. So yield trap is real, especially for all the dividend strategies. Like how the swing traders carried away with the current market news and other stuff, yield trap is another a trap for the dividend strategy investors to go put money into a company where the company doesn't perform as expected, right? So that's kind of we call it as yield trap. When you look at high yield companies, generally when you have a higher yield means riskier investment. So you have to be very cautious in investing money there. And some of the higher yield leads to decrease in the stock price. They will pay you higher yield, but at the same time they cut down the stock price also. Your capital growth won't be there. You could see that your investment going down too. So if you have invested 10K in a stock of $10, now after they pay you the dividend, they cut down their stock price to $9, which means that your total investment in that company goes down 1%, right, or 10%. That's kind of the strategy some of these companies do. So they pay you higher yield, but at the same time they cut down the stock price too. When you have a high yield, some of these companies don't grow their capital also on a regular basis. So you will have a slow capital growth, and at the same time, sometimes to keep up with the demand, they will give you a high yield for a couple quarters, and after that they cut down. So there's a good chance that some of these high yield companies will, down the line, because of their broken financial conditions or their practices, they will start cutting down the dividend payments. So that's another problem we have seen on a regular basis, especially on the dividend strategy. So yield trap is real. Watch out for the stocks companies who are paying high yield, but definitely they have something going wrong in their business or in their sector. So watch out for it before investing. So that leads us to the next one, which is net asset value erosion. This is another topic, interesting topic. It is more deeper technical, but it's one thing you need to know when you are taking this dividend strategy. Looking at the NAV erosion, NAV is nothing but the net asset value. Generally, companies calculate their dividend based on the net asset value, NAV. Okay. Anytime when you see a decline in the NAV over time, this is kind of an indicator or a signal for you to look at deeper into the company to see what's going on. Either they are performing not up to the par, performance is not up to the par, or could be something else going on behind the scenes which we don't know, either a management problem or a sector problem or an industry problem, different set of problems which would have caused an impact in their businesses as well as their returns, which in turn caused an impact to your net asset value. Impact of this is primarily declines the distribution or your dividend distribution, and also it has an impact to your capital gain. Let's go a little bit deeper into that. Let's look at this particular stock. Stock name is TSLY. This has a dividend yield of 84.63%, which is way high, with an expense ratio of 1%, 1.01%. I did invest in this particular stock, so I have some calculations done based on my research. So I did buy this shares, 100 shares for 21.55 purchase price, and at the time of purchase, the total value of my purchase or the equity is 2,155, and then they are giving an yield of 84.63 percentage. Basically they divide this 84.63 percentage for 12 months, so then you can calculate how much you get per month. So you're looking at somewhere around 5-8 percentage in an average. 6 to 7 percentage is kind of the range. You can see that in the chart, in the table. So you could see I calculated from Jan 2024 to all the way and 2025, and you can see the dividend income, net asset value. Initially it started out with $21, and gradually it started coming down. What it does, it also has an impact to your dividend income. So the percentage also changes, your dividend income also changes. So there is a decrease in the dividend income the as the net asset value gradually decreasing, right? Kind of erosion problem. And you can see the percentage, dividend percentage too. So when you look at it, end of the day, like after 12 months of having this investment, you're looking at somewhere around 1,200 as your dividend received from this particular stock. But what this NAV erosion will do is that if you look at your total equity value per month, you could see initially you invested 2,155 based on the purchase price for 100 shares. On Jan month, it slightly went up because the NAV is around 21.88. So you are looking at $33 of addition to your total equity. Just look at the total equity value per month. As the NAV goes down, your total equity value per month is also going down if you're calculating based on the net asset value. The actual stock price might differ slightly, 1 or 2% higher, kind of plus or minus. But if you calculate based on net asset value, you could see that total equity value per month is also decreasing. So you're one side you're receiving the dividend, the other side, your total equity is also going down. So the dividend is actually compensating the NAV erosion. So is it good or bad? There is nothing negative about it. Down the line, your stock price will come up. It's kind of fluctuation, so there's a good chance that the prices will come up, stock price will go up. You could see that the NAV will also go up in that particular time. So especially when you're dealing with ETFs, this is very common. You could see that the NAV going down or fluctuating and coming up as and when the market or comes back. So this is very common. It's not a concerning one, but it is a thing which you need to keep an eye on. Watch out how these stocks are performing. Let's look at the market condition. I'm recording this on Feb 21st. And one of the things which I always look at it is the ETF, SPDR ETF, where all the major companies are there or leaders are there. And looking at the spider, it was in a good trend since August 2024 all the way till December. But from since December, it has been in the sideways turn. So I usually use this box mechanism to get the confirmation when to get in, when to get out. So that's one of my approach. It works. It works. Generally, it works for me. And I think most of the financial investors are using this kind of mechanism. It's called as Darwin's box theory. That helps you to understand what is your resistance and support level and how the price movement are going to be within that range. So uh, looking at the sideways churn, I'm in the 4 hours chart right now. It did come out of the box. If you look at it, there are smaller boxes which confirms the churn, smaller churns, and a bigger box which confirms me the bigger churn. Right. So the price is within this bigger box, and it did come out of the price resistance level recently, but there was some level of downward pressure, which I think past 2 days we are seeing the price actually went down. If the price would have come out of that resistance, which confirms us the buyers are ready to invest more, but it didn't happen. So that's a confirmation for me to say that, yeah, what, the trend actually changed. The price will come down. Looking at the trend, it did come out with a bit of pressure, brought down the price yesterday, good 1.5 percentage down, and similarly we have seen that today also. So it is very cautious environment right now, and I think people, it's fair to say that they're waiting for how the new financial policies are going to turn out to be. We have to wait till I think the price has hit the mean right now. If the trend is changing here, if it is upward movement, that's kind of mean reversal thing. You have a window to hit all the way till 610. So that's kind of an indicator for me. If the trend changes here after them hitting the mean, we basically call as mean reversal happens, then that's the confirmation. If the downward pressure is there, then good chance that it could hit the support level too. So we have to wait and see how the market trends now. And all the big time retailers, big time companies have come up a little bit cautious in the forecast right now. For example, Walmart, they're not sure what's going to be their forecast is going to be. I think they have taken a cautious route, saying that their forecast, the earnings are going to be impacted by some of the new tariffs implemented. So we have to wait for what type of margins they're going to get down the line this year. So overall, it is in a kind of sideways turn. It has not taken the negative turn yet. It is in the sideways turn. At some point, if it breaks out of this resistance level, that's the point for us to confirm that, that's the time to go invest money back into the market. So wait for that moment to happen. The first stock we're going to talk about is the Goldman Sachs S&P 500 Core Premium Income ETF. So the stocks which I'm discussing going forward, mostly it will be dividend strategy based stocks, and some of these stocks are, they pay you dividend on a monthly basis compared to quarterly basis. Some other stocks, like if you have invested in Spider, the one which we discussed previously, they pay you on a quarterly basis, and sometimes the payment dates are down maybe a month or 2 months later after they declare the ex dividend dates. So some of these big time stocks take time to pay the dividend amounts, but these stocks pretty much follows the same pattern investment model they have, the holdings they have, especially these ETFs, but they pay you faster and they are monthly too. So if you're planning for a passive income, monthly income, then these are some of the stocks which are very good. So you can start investing now and see how they are giving you or paying you the dividend on a monthly basis, and then plan accordingly your expenses too. So these are some of the stocks which I wanted to share. First one is the Goldman Sachs. But looking into this particular stock, uh, majority of the market is in the sideways movement, which means that some of these big time dividend paying stocks are also in kind of cautious mode. So you could see that the box which I drew, it is in the sideways turn, and the resistance and the support. So you're looking at somewhere from, the support is around 48.33, and then the resistance is about 50.80. Around 51 is the reasonable resistant level I see. And past few months it has really good growth. You can see the trend line. So you are around somewhere around 11 percentage growth, good growth. These Some of these ETFs grow very slow, but at the same time they pay you dividend on a regular basis. And this particular ETF is a brand new ETF. They started 2023 October timeframe. Strategy is pretty much the same. You follow the S&P Spider ETF, similar holdings. So if I go a little bit deeper into the fund, you can see that the fund is around, the total assets is around 518 million something. 8.17 percentage is a dividend, which is higher dividend compared to a dividend yield, which is higher than any average good paying dividend stocks. And this is actually an ETF, so that's again one more thing. And it is coming from a good branded company called Goldman Sachs. They have their own drawbacks, downfalls too, but their overall strategy is pretty decent. And looking at their investment style, electronics 22 percentage, technology 19 percentage, finance 12 percentage, and the rest are all single digits. And a little bit deeper into it, what are their top holdings? Apple, Nvidia, Microsoft, Amazon. So if you compare this holding with a Spider, if I go back to the Spider stock and do the same thing, if I look into a little bit deeper about what funds they have pretty much the same thing. The only difference is the assets are in around billions. The other stock is in millions. So they're slowly growing. At some point, and then if you look at the prices wise, Spider is around $600. But if you switch back to the Goldman Sachs one, which is around $50. So you see the price difference. The ETF price difference is also there. If you cannot invest $600, you can choose some of these alternate stocks, which are growing stocks. Pretty much follows the same S&P 5 model. And the holding wise, they are same standard holding. If you go down and see the percentage wise, they are pretty same, and their top holdings are also same. If you compare with the Spider and the Goldman Sachs, they are pretty much the same holdings. So overall, it's a very good ETF. On a long run, I think they pay you good dividend, around 8% different, which is good one. If you invest gradually and reinvest the dividend also, they compound very well on a regular basis. So from the growth standpoint, stock has been kind of past few months, it's been in the sideways moment. So this is a good time whenever you see a pullback, like pullbacks like these, negative, half late past 2 days, Thursday and Friday, Feb 20th and Feb 21st. If you have seen, there was a pullback. So those are some of the times. Take those opportunities to invest smaller amounts and keep this fund growing. You could see that they are giving you on a monthly basis good dividend here. So it's around 0.358, which is kind of 8% is the annual dividend yield. But if you break it down into 12 months, you're looking at somewhere around 0.7 percentage, 0.6 percentage, yeah, 0.06 percentage, something like that. So you are getting a decent return on a monthly basis. So from the stock standpoint, it is a very good growing stock. So keep an eye on it. So this is the first stock I wanted to discuss. Here's one more ETF, which is an high yield ETF, high paying ETF, and this is a quarterly income or dividend ETF. It's called Vanguard High Dividend Yield, VYM. That's the ticker symbol. So looking at the performance wise, since October 2023 till now, it has actually gone up 33 percentage, 30 percentage, close to 30 percentage, which is a good growth. In addition to that, they do provide you a dividend of 2.62 percentage annually. So if you divide that into 4 quarters, then you can calculate based on that. That's going to be your dividend. And the CTF is kind of a high yield. Obviously, they have invested it in the leaders in those sectors. So looking at the fund details and their allocation, so it's around 61.76 billion total asset allocation is. And some of the major sectors, top 5 sectors are finance, technology, health technology, consumers, retail business. I think those are our top 5 sectors for this particular ETF. And the top holdings are think very common ones. The Broadcom. This is the second top semiconductor company. JP Morgan, ExxonMobil, Walmart, Home Depot, P&G. These are top 5 to 10 holdings for this particular ETF. So they've invested it in the right companies. Growth wise, it's going to see a steady growth, not significant spikes here and there, but you will see a steady growth as these leaders grow slowly. This particular stock will also be growing. So from $99 somewhere, it has gone up to 134. Off late, since December, it's been in the sideways turn. So there was a good pullback. There was an opportunity for investing. It came down to 127. Now it has hit the peak. I'm expecting the price should come down, because even in the RSI side, the demand is slowly draining. So you should see somewhere coming down to in the midpoint around 47.20 metrics. That's where I would say the price will be hitting to the mean, and then you should see a mean reversal. So you should see that price moving up. I'm expecting this upcoming weeks and months going to be slow movement, as some of these retail sectors have taken a cautious forecast. So watch out for it. But if you invest money in this, it's going to give you a steady dividend. So there's no change in their dividend strategy or in their percentage. So that's going to be fixed with a very minor expense ratio for this particular ETF. So I would say this is a really good dividend paying ETF. Invest in it. Just take the dividend on a regular basis. The next talk is about a well-known company, Coca-Cola. KO is the ticker symbol, and it's been consistently performing well. You could see some of the returns are for a year, it's around 16 percentage. So good growth, and they pay you a dividend of 2.72 percentage, which is also good. And Coca-Cola, they've been consistently performing well. They had earnings on a regular basis, meeting the expectations. It's a well run company, and their demand is also steady and gradually growing too. So from the revenue standpoint, they are pretty good. Earnings standpoint, they're very good. From the dividend standpoint, they pay you around 2.72 percentage, which is kind of decent, I would say, for some of these companies. Consistent across these companies. And now the other company is the Procter and Gamble, pretty much matches the payment model, the dividend percentage. These are good, solid companies where you can invest on. And from the growth standpoint, most of these dividend paying companies, they will be slow in the growth. So your capital gain will be, or capital growth will be very slow. However, they will be providing you a dividend on a regular basis. And this company has been paying dividend for ages, decades, I would say 50, 60 years. So it's a trustable company you can invest on, and invest in a right time, especially when there is a pullback. That's the point where you invest in. So if you look at it since 2022, there was a good sideways churn. Whenever there was a pullback, those are the opportunities to invest some money in it. You can see the resistance level is around 66, and the support level is around 54. So it was churning within this resistance and support level, uh, and then went down. October is a time where most of the stocks have been came out of that break, then started performing. So from since October 2023, from 51 to 71, so around 50 percentage growth, I would say. So first initially 16 percentage, the other one is 20 percentage. So you're looking at somewhere around 40 percentage growth. And off late, it was showing you a good cup and handle kind of pattern here. That's another indicator. Some of these well-run companies or stocks will show you some of these standard patterns too. So this is we do see a cup and handle pattern here showing up. It doesn't matter generally for some of these dividend paying stocks, these patterns will come on a regular basis. But I would say these are trusted companies you can invest anytime, especially when you see a pullback. That's the time you just put some money. So do a smaller allocation on a regular basis and get use of this dividend stuff too. So they are paying you around 2.72 percentage. They are quarterly dividend company. From the growth standpoint, you should see a steady growth. You're looking at somewhere around 16 percentage per year. That's a steady growth. So you can allocate your funds in your portfolio based on how much return you want. And this is around 13 to 16 percentage growth. Is a very decent growth, very common growth. So you could put some money and get the dividend too. From the technical standpoint, these are trusted ones. So the demand has exhausted. It has the RSI reached the max. So we should see some level of downfall in the price. It should come back to the mean somewhere around 66 something, 65. That's the range which I see. It should come back to that, and then it should pick up again. So that's the price moment I'm expecting here, because the RSI shows that there's going to be a downfall there, price downwards pressure. So we should see the price coming down and then gradually picking up. But from the dividend standpoint, it's a very, very good company to invest on and get the dividend. Thanks for watching my video. Stay tuned for more updates, more interesting topics to cover in the future. Until then, stay invested. Thank you.